All right, welcome. Today, we're diving deep into something that's kind of like the hidden engine of the financial world, the market maker. These guys are the real reason our markets aren't just markets, but are incredibly fast and super efficient.
I mean, have you ever really thought about it? You top buy on a stock, and boom, it's yours, just like that. How on earth does that happen so fast? Who's always there, on the other side of your trade, ready to go 24/7? Well, that's the puzzle we're going to solve today.
Okay, so here's our game plan. First up, we'll nail down what a market maker actually is. Then, we'll get into how they keep the whole market flowing smoothly. We'll also break down this whole makers versus takers thing. After that, we'll see how they actually make money from all this. And finally, we'll wrap up by looking at why they're basically the unsung heroes of the entire system.
All right, first things first. So what is a market maker? Let's get right into it.
In simple terms, a market maker is a company that's always, and I mean always, willing to do two things at the same time: buy a stock and sell a stock. They're constantly putting out two prices for everyone to see: a bid price, which is what they'll pay you, and an ask price, which is what they'll sell it to you for. And that constant presence, that's the secret sauce to a liquid market.
And that brings us to their main job, which is keeping the markets flowing. A great way to think about it is like a river. For a river to be healthy, the water has to move freely, right? Well, it's the same with money and stocks. And market makers, they're the ones who make sure that river never ever runs dry.
Okay, here's a perfect example. Let's say you want to sell a stock, but in that exact millisecond, there isn't another person out there who wants to buy it. What happens? Well, without a market maker, you'd just be stuck waiting. But instead, the market maker instantly steps in and buys it from you. They guarantee your trade goes through right away. They're like the ultimate trading partner.
And when you look at it side by side, the difference is just night and day. Without these guys, markets would be slow, clunky, and way riskier. It'd be so much harder to trade. But with them, we get the instant, smooth, and super efficient markets that we all kind of take for granted today. So this all leads to two really fundamental roles in every single transaction: the makers and the takers. And it's not just about who's buying and who's selling, it's really about who is providing the liquidity and who is using it.
Okay, check this out. A maker order is one that adds liquidity. It's an order that just sits there on the market's order book, patiently waiting for someone to come along and fill it. A taker order, on the other hand, removes liquidity. It does this by instantly matching with one of those waiting orders. So, because market makers constantly have orders just waiting there, they are, by definition, the ultimate makers.
So you can think of it like this: a little story of a trade. Step 1, a maker, let's say our market maker, places their buy and sell orders in the book. Step 2, those orders just wait, chilling out, adding that crucial liquidity to the market. Then, step 3, a taker comes along, and bam, their order instantly matches with one of the waiting ones. And just like that, the transaction is complete.
Okay, so if they're providing this massive, essential service, how do they get paid for it? It's actually a pretty fascinating business model. It's all built on making tiny profits, but doing it millions of times over.
And it all comes down to this thing called the bid-ask spread. The bid, that's the price the market maker will buy from you. The ask, that's the slightly higher price they'll sell to you. And that tiny little difference between those two prices, that's the spread. And that's where they make their money.
And this is a really important point. They aren't betting on whether a stock is going to go up or down. That's not their game. Their job is just to make trading happen smoothly, and they make money by capturing that tiny spread as their fee for providing that instant liquidity.
Let's make this super concrete. A market maker puts out a bid, saying, hey, I'll buy this asset for exactly $10.
And at the very same time, they post an ask saying, and I'll sell that same asset for $10.01. So when they manage to buy at $10 and then sell at $10.01, they've captured that 1 cent difference. That's their profit. Now, just try to imagine doing that millions or even billions of times a day.
So let's zoom out and put this all together. Why do some people call market makers the unsung heroes of the market? What's the big deal?
So let's just quickly recap the main takeaways here. Number 1, market makers provide liquidity, which just means there's always someone on the other side of your trade. Number 2, this is what allows all of us to trade quickly and efficiently. And number 3, they get paid for this service by earning a tiny profit on the spread. Simple as that.
And this might just be their most important job of all. When markets start getting crazy and volatile, they're the ones who provide stability. They stop prices from jumping around wildly because they are always there quoting a reasonable bid and a reasonable ask. It really helps keep the market orderly when things could otherwise get out of hand. And that, That leaves us with a really fascinating final thought. In a world that's getting faster every day, with high-frequency trading and AI taking over, the job of the market maker is changing, big time. So what's their role going to look like in the next decade? It's a huge question, and the answer is probably going to define the future of our financial markets.